Corporate bonds. They're not flashy enough to steal the spotlight like stocks, but they're not safe enough either to be called a low-risk asset like government debt. They actually sit right in the middle. When markets shift, when inflation bites, when growth slows, when volatility creeps in, this middle ground can suddenly become very interesting for investors. So today we are breaking it down: what corporate bonds are, how they differ from sovereign bonds, how they compare to stocks, and more importantly, how you can actually invest in them. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So recently I have been asked to dive into corporate bonds as the next educational video, so let's dive straight in. In short, a corporate bond is just a loan. You lend money to a company and in return, the company promises two things: to pay you interest, what we call the coupon, and to repay your initial investment at maturity. As a corporate bond holder, you have no ownership, no voting rights, and no participation in explosive upside. You have just a contract. And that leads to a key idea. With bonds, you're not betting on success of a company, but you're betting on its survival. As long as the company doesn't default, you get paid. Now, zooming out, there are two main types of bonds investors think about: sovereign bonds and corporate bonds. Remember, sovereign bonds are issued by governments. Think of US treasuries or German bonds, for example. They're generally considered the safest assets in the financial markets, especially in developed economies, because governments of the developed world can tax and, in many cases, print money to pay investors back. Corporate bonds, on the other hand, are issued by companies, and companies don't have that same safety net. They depend on revenues, they depend on margins, and their access to financing. They cannot print money, they cannot tax people to pay you back. So naturally, they carry more risk. If things go wrong, well, they could default. And in financial markets, more risk means one thing: more yield. And that extra compensation investors demand to hold corporate bonds instead of government bonds is called the credit spread. The higher the risk, the higher the spread. In times of crisis, the riskier bonds credit spreads actually tend to make bigger moves. As such, the credit spread is one of the clearest signals of market sentiment for investors. When spreads are tight, confidence is high, and when spreads widen, fear is creeping in. At this point, you're probably asking, why buy a corporate bond instead of a stock, right? That's because at first glance, stocks seem more attractive. They offer growth, upside, and the potential for stronger returns. But they also come with full exposure to the downside. When you buy a stock, you own part of the company. If it thrives, you benefit. But if it struggles, you take the hit, and in the worst case scenario, shareholders are last in the line of repayment. This is where it's interesting for bondholders, because they, on the other hand, come first if there is a repayment. If a company defaults, they are the first actually to get their money back. Equity holders are, on the contrary, in the last position. And that's the key distinction between owning equity and owning a bond. With stocks, your upside is unlimited, but so is your volatility. With bonds, on the other hand, the upside is limited, but you have less risk. There is something many people overlook. Corporate bonds don't just sit there until their maturity. They actually trade every day on what's called the secondary market. That means once a bond is issued, you can actually buy it, you can sell it before it matures, just like you would with a stock, and you can take the hit or you can make a little benefit out of it. And this is where things get a little bit more interesting, because bond prices move. If interest rates rise, for example, existing bonds with lower coupons become less attractive to investors, so their prices tend to fall. And if rates fall, well, those same bonds become more valuable, so their price rises. And beyond rates, credit risk matters too. If investors become worried about a company's health, the bond price drops. And the same way, if confidence improves, the price recovers. So even though bonds are often seen as boring fixed income, well, their prices are anything but fixed or boring. You can actually sell your bonds with a gain, again, as I said, but because the amount that will be repaid at maturity is fixed, well, the value cannot go very, very high, and that is limiting the upside potential when you're holding bonds. So in summary, the trade-off is quite simple. Stocks are about growth, bonds are about protection. So when do corporate bonds actually become interesting to hold? First, when yields are high. If you can lock in a 5, 6, even 7% yield from solid US companies, for example, well, that becomes quite compelling, especially compared to low yield environments. Second, when recession fears are rising but not realized just yet. This is often the sweet spot because markets price in risk, spreads widen, yields increase, but defaults haven't materialized just yet. And third, when equity valuations feel stretched. If stocks look expensive, corporate bonds can actually offer a more balanced way to stay invested, earning income without fully taking the equity risk. And finally, it is interesting to hold corporate bonds when you want income over volatility. Now, how do they behave compared to stocks? In strong economic expansion, stocks tend to outperform bonds. Corporate bonds participate, yes, but they have a limited upside. In periods of slowdown, however, bonds, especially higher quality ones, can hold up better, supported by income. But in a real crisis, actually, both can fall together, leaving the typical 60-40 portfolio holders, for example, looking desperately for better protection. And this is where the distinction between the high and low yielding bonds matter. Investment grade bonds are more defensive and they do better in times of crisis, whereas high yield bonds behave much more like equities. So if you think all bonds are safe, well, think again. Because a company with ample and stable revenue and ample cash flow will pay less return, sure, but it will also help you get a better sleep through volatile periods, while high-yielding corporate bonds will give you more return, but they are going to be at jeopardy when things become hectic. Now, all this is good, but how do you actually invest in corporate bonds? Well, there are a few ways to do so. You can first buy individual bonds through a broker. In this context, you choose a specific company. You may choose a specific currency if available. You choose the maturity and the yield. If you hold the bond to maturity, you get your principal back, assuming no default, of course. As I said before, you can sell the bond before maturity and get reimbursed at the market price that could be below or above par. But this market isn't always very accessible. Minimum sizes can be large, pricing isn't always transparent, and liquidity can vary as well because the bonds are traded over the counter. So more commonly, investors go through funds or ETFs. These instruments give you exposure to a basket of corporate bonds, diversified across companies, diversified across maturities, and much easier to buy and sell as well, because you can simply trade them just like stocks with daily liquidity. And this way you can also have a diversified portfolio of corporate bonds. So zooming out, portfolio diversification by building exposure to bonds is very common. When we speak about 60-40 portfolios, the 40% of the bond exposure could actually include sovereign and corporate bonds. Again, it's important to remember that they are not risk-free, but they are an interesting hybrid asset for investors willing to smoothen out volatility while getting periodic returns. So when markets feel stretched, when uncertainty builds, when the outlook becomes less clear, ask yourself, am I being paid enough to take equity risk? Or is this a moment to lean into credit? Because sometimes the most interesting opportunities sit right in the middle. So this is all for this episode on corporate bonds. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this educative episode has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Visit our blog for articles that we publish there on a regular basis. So I will meet you very soon, and until then, goodbye.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.